When we talk about the fundamental news, we are talking about the news that are going to affect the market either a negative form or a positive form, and these are going to affect actually the currencies. So as a beginner, as someone who actually trained on the forex market, whether you are a trader, whether you are scalper, or anybody you just are on the forex market, whatever the strategy you just use, you have to be knowing about the fundamental news, because actually you can just be making good amount of money consistently, but actually when the high impact news happen, they can just wipe all your profit that actually you have been making even in the full amount of the week. So this topic, this video is just going to be very important to you. There's no intro, we are just going to start right after this, but make sure that you subscribe to the channel, turn on notification. If you have a question, you can just leave it in the comment section. Let's start right now. So when we talk about the fundamental news, you can see something like this. So you can see this movement right over here, where the market actually moved in one day, right, from 1.094 and then just moved up to this place. So actually this is just one day, and you can see actually there are a lot of pips right over there. That is more than 2,000, that is more than 200 pips, the movement right over there. So the fundamental news has the capability of actually changing market and making things change in an instant and all that. So that is why it is very important actually to check on the fundamental news even when you are a technical trader. That will just be very important. And actually what makes this market move from this place to this place, let's check. If you just go to the forex factory calendar, that is where you just be checking the update, where you can just be checking your things. All you just have to do is type forex factory calendar right over there, and then you just go to the calendar. This is where you just be checking your information right over here. For example, let it go on the Friday, February 3rd, and as you can see, there's something that was actually printed right over here, and that is farm employment change. And actually the expectations were 193,000 jobs, but actually it printed very high jobs in terms of numbers right over there, and actually that shook the market, and it made the market actually to just the USD, and you can see that is on in US, okay, and this made actually the US dollar to strengthen so much. So as you know that when there's the US dollar actually strengthened, then the euro actually loses, and that's why we got this market going down all this way from this point to that point. So that is what happened. The dollar actually gained, and then the euro actually lost in this way, and we just got something just like this. So that's how this market actually can just be affected by the fundamental news. Let's just check over here 3 things that actually can just be affecting the market, how you just be interpreting them, and how they are just very important into the market. So over here I'm going to be talking about the fundamental analysis. So this is very important. What are you supposed to be checking on the fundamental analysis anytime you just go to the market? This is very easy. This is very easy. All you just have to know is that the fundamental news, you just have to be checking actually specific currency, okay, specific currency. Actually you have to start with the US dollar, because actually all commodities, all stocks, actually they are written in terms of US dollar, okay. Their value actually is approximated in terms of US dollar. So it is very important for you actually to know about the US dollar. This is actually the reserve currency, okay. So you have to know about this dollar. So in this fundamental news we'll just be talking about the US dollar. So there are a lot of things that you have to be knowing over here, like export, import, and all those things. That's very important into these things. So there are a lot of major things to be checking on the USD, major things to check, okay, and that is what we'll just be discussing in this class right over here. And number one of it actually is what we call the inflation, okay. We have inflation, or we can just call this CPI, okay. We call that CPI. We'll just be checking on that is interest rate, interest rate, all these things. The two of these are like they depend on each other. When then we have an employment rate, employment Okay, so actually we can just check on these things, three of them, and we have an addition of them, which is actually industrial production, or we can just call it consumer. There is also the consumer confidence that just give the sentiment of the market, but let's just call this number 4 GDP. Okay, GDP. This is gross domestic products. So these things over here which are very important in the forex factory calendar, then you just have to be checking on this. But actually if you just want to concentrate on the USD, you can just be checking this on the USD. You can just go to the euro and just be checking all those things. But first make sure that you learn on the USD market. Okay, so let's learn how there is just be talking about 3 of them and almost 4 of them over here in this video, and you're just going to understand how actually they affect the market. Let's start with unemployment. How do unemployment or employment affect the market? How employment affect the economy, how employment actually affects the economy. So we have actually when the people actually get the job, when people lose the job and all that. This is very simple actually in the forex market. So all you just have to do first of all is to go to the forex factory calendar, and then you just check something that I've just showed you already, and this one over here, which you can see over here 517, and actually you can see it is positive, and you can see actually it, you know, these things about the actual, this is actual, this is the prediction, and this was previous one. Okay, 260 was previous, prediction was this, and this is what was printed. So that means that when you see something like this, you can see already it is green, which means there is positive about that. So when employment actually increases, you can see over here, you know, when employment actually increases, it tends actually to strengthen the currency, because people got jobs, people are getting money, and that's why they are getting money to spend actually in the economy, to buying goods and services, and that's why invest something like that, and then it will just strengthen the currency to become more good. And what will happen when the currency actually strengthened in the market? So on that time, you know, just bring that sentiment, that feelings to the traders, and then they just execute the market. And we always see the market moving very fast, very volatile in the market, and market moving very fast. So what will happen, for example, we have euro USD right over here. So what will happen if this strengthens is like saying this, of course this is always 1, and then it's like dividing. Okay, so when this strengthens, assume now it was 1 and now it has strengthened, which means that it has increased in value. Okay, so what will happen, 1/1 it was here. So when we talk about this strengthening and we put 2, you can see now this will become 0.5, which means the market will just go down. Okay, for the euro USD, the market will just go down. Okay, so it's like denominator. When you increase the denominator, then the overall was just goes down. So what if this value was printed over here was, what if the value that was printed over here was red? So what could happen, of course is the opposite of this, because the dollar actually could weaken. The dollar could have weakened, and after dollar weakening actually, then we have this going up. Okay, we could have this going up because the dollar become less. So it's like saying 1 divided by 0. Like 1, it was 1, and when we divide by 0.5, then this becomes actually 2. See, 2, yeah, it becomes 2. So you can see it has gone up from 1 to 2. So that's how the market can just be affected by employment rate and fundamental news. So we are just going to be discussing the rest. So that was the number 1 in this topic. So any moment you just hear about the interest rate, something coming about the interest rate, maybe you asking yourself what are the effect of the interest rate to the market. So in this video I'm just going to be explaining actually how the interest rate affect the market, and how actually the government actually comes up with these things. Not the government, but actually the central bank, how the central bank actually comes with these things of the interest rate and why. Now as you can see right over here, this is a howdy, and this is, I just pick this random chart right over here, and this is actually the hondi, that is Australian dollar, and you can see bank actually expectantly cut the interest rate, and this is what actually happened. The market actually moved right from this point, and then the market actually went up to this point. That is crazy. That means that actually the interest rate has a very big effect, especially to the market. Now what happens over here is actually we have AUD/USD, and if actually we see this big movement right over here happening, it means that the AUD actually, this one, after cutting the interest rate, then this actually weakens. Okay, so this will weaken. Now how do we come actually with this interest rate actually weakening the currency, and why do government actually, that is the central bank, why do they come up with these things? So here we're just going to be talking about the interest rate to the market, and you just understand this very easily on these things. Now when we talk about the interest rate, we are talking about the government trying to control the economy. There are two reasons actually why the government actually can implement the interest rate. That is to manage the inflation, and also the government actually can manage stability of their country exchange, okay, of the country exchange rate, so that they can just manage that. So this is the reason why the government actually could might actually that the central bank, sorry, could increase the interest rate or reduce them. Now this is the flow of how everything just happens in the interest rate, and why the government actually, the central bank, I don't know why I'm putting the government in central bank, okay, but the central bank, this is the reason actually just does that. Now we have this actually something we call economic expansion. We have economy expanding. So let's just draw this here so that you can just understand it more. So we have economy expansion. That means over here we have where people actually get jobs. We have people investing a lot of money. We have people who have, the economy is growing very fast. That means there's rise in GBP, okay, there's rise in GDP, that is domestic gross domestic production, okay. There is increase in employment, the people are employed, increase in employment, there is people are high investment, and actually this convert to people having money. So it means people have money, okay, people have money. So when this actually happens, when people have a lot of money, they tend actually to cause something we call inflation. So what happen over here is that it will cause inflation to increase. So what they cause over here is inflation increase, okay, inflation increase. That means if there's something that was actually costing $10, then that something is maybe going to be costing $11 or $12, because people have money, and that they cause inflation to go high. So it means the inflation is just going to go high. So what the central bank will just do over here, it is going actually to hike interest rate, okay, hike interest rate. They will hike interest rate, and the moment actually they hike interest rate, yeah, what happens over here is that people now will stop spending a lot of money, that being of discouraged maybe to spend a lot of money. The people now that people of actually having a lot of money spending, and the circulations of money actually will just increase right over here. So things will start slowing down. Okay, things will now start slowing down. That's actually why the government actually could hike the interest rate, so that they can control the inflation that is maybe the circulation of money. The money is circulating very fast, and if there is something that actually costing this amount of money, it is just costing higher. So that's how the central bank actually can control the interest rate. But actually, when the interest rate actually when they continue hiking the interest rate, what happens is that the economy actually contrasts. Okay, economy contrast, economy contrast. Okay, so that means actually there is no money in the economy. Things are very expensive, they cannot be bought, something like that. It is opposite of whatever we just discussed over here. There is decrease in GDP, there is increase in unemployment, there is low investment, and actually people don't have money. So after hiking the interest rate, so what the government actually could do after the economy actually increasing trade, economy will just contrast. And what government now do is now to lower the interest rate, that is to cut. What they will just do over here is they are going to cut they are going to cut interest rate. So when the government actually cut interest rate, what will happen over here again is that economy will just start expanding again. People will have money, people will just invest more, there will be rise in GDP and all that. And when that becomes excess and all that is just goes higher, then the economy starts expanding, and then the government actually start increasing the inflation increases, the government hikes the interest again, and the economy actually contrasts. After economy contrasting, then what will happen to the central bank? They will just cut the interest rate. After the cutting the interest rate, they continue cutting the interest rate. The increase in unemployment increases, there's increase in there is a reduction of people are investing more, increasement of investment, then people start having a lot of money, and the cycle goes on and on and on again. So what will happen over here is that actually in the increase of hiking, when the government actually hike the interest rate, here is what we just expect over here. What will happen over here is the currency actually start gaining, the strength start gaining. People would actually love to invest where there is high interest rate, something like that, so that the currency is just gaining and becoming with high strength, something like that. But the opposite of hiking interest rate over here, on the cutting interest rate over here, this is where the currency actually weakens. Okay, so this is a very big concern to the actually investor, because they just want to know the direction of the market in this scenario. So let's say actually to apply this in the market, let's say actually we are trading euro USD in the real market over here. And actually what will happen over here is that, assume now the Fed is going to increase the interest rate. Fed increase the interest rate, what we call hiking the interest rate. Okay, hike interest rate, increase interest rate. So what will happen actually to USD is the USD will just start to strengthen. Okay, will strengthen against euro. Okay, so what will happen over here, if you have euro USD on the graph right over here, this upward movement, and over here we get interest rate, let me write interest rate IR over here, and they are being hiked. So this one will start gaining, and when this becomes more, because this is the quote currency, what we expect is the downside. So the market, we expect it to go to the downside. So when we hear about the IK interest rate, just know it's going to be strengthening the dollar. Okay, so interest rate is directly proportional to the strength of the currency. This is not only for your Euro USD but also for all the countries where they have actually all those things, central bank controlling the price and the strength of the currency to avoid inflation and all those things. So that is what you just get right over here. What about when we have the government actually reducing the interest rate over here on the Euro USD? What will happen right over here is that becomes weak, and then the market actually just goes up because this will become small, this is big. So you can just do that calculation and you can see the market will just start going up. Actually, this is very good for day traders, people who actually, because actually the way you can see over here, this is a 4-hour time frame right over here, and I can see actually the market kept going down up to this point. So it can just take, even some days the market actually keep going up and up again. Remember, now we are on this one. Let me show you something here about the Euro USD. Remember, actually the reason actually the Euro USD actually rose to this area, went up to this region right over here from this point, from 0.95 up to this point, is where the government actually started reducing and cutting the interest rate, and now the dollar was actually losing against the euro because euro was actually increasing the interest rate. But this one, as you can see right over here, we are waiting on the news to happen. Stock rise, dollar did ahead of Fed decision to increase the interest rate right over there. If you just want to check where you can see all those interest rate things, then you can just actually go to the Forex factory calendar right over there, and then you just be being updated over here, or you can just filter and go and filter this to expect an impact and then apply the filter, and then you can see on February 1st we are expecting at, this is 2 p.m. Wednesday 2 p.m. we have Wednesday 2 p.m. over here, the Fed actually interest hiking the interest rate right over here. Let me just refresh this so that you can see it well. Let's see, we have the government actually here trying to hike the interest rate, that is at 10 p.m. over here, and you can see actually it's just going to increase by 2.25 bps, that is 25 points right over there, that is 0.25 percentage right over here. So what will happen over here, because this is USD, we may expect it to strengthen a little bit because this is just 25 bps right over there. But also if the euro actually will also gain in terms of interest rate, then we expect some fight happening over there. So that's how you just check these things that are very easy to interpret and very easy, just like that. Hello traders, so today we are going to be checking on how CPI actually affects the market, and this is going to be very amazing because this is actually the fundamental class. And the reason I'm talking about the CPI, the reason we are going to start with the CPI is the reason being today we are expecting news to come over here, and the news that we have on our calendar right over here is that on 6 that is at 4:30 p.m. actually you can see the CPI monthly. CPI is estimated to be released over here, and the CPI yearly and all these are just going to be expected to be released in the USA. As you just know, the reason we are interested in USD dollar is the reason that this actually is the measure of money, commodities, stocks and all that, and actually this USD, you have to know that. So starting over here, let's go to the direct to the our questions over here. CPI. So you may be asking yourself what the word CPI means. Let's just start from there so that we also do some history to know how the CPI actually has been affecting the market in previous days. So the word CPI actually represents the word name, which is a consumer price index. This is a consumer price index. Consumer price index. Consumer price index. So actually, okay, this name is actually come from most of people, those you don't know, It's just also known as inflation. So this is the inflation measure. So it's just the inflation measure. So that is what we call the CPI. And actually, if you just want to know, for example, let's say the reason actually, you see, like in my country over here, there is time maybe we could purchase maybe a bread at 50 bob, okay? But now actually the reason now the brand actually can just be, maybe the brand actually was even going not even 50 bob. Our time actually, we were buying the bread sometimes back, we were buying brand at 15 bob, but actually now the brand is just going to at 60 bob. The reason this money has just risen from this value to this value is actually because of CPI, or because of inflation rate. This is inflation. The reason you can buy the same product but with a higher amount of money, that is what we call the inflation. And actually, if you just want to calculate the CPI, how do you calculate actually the CPI? This is the cost of the product and services in previous. Cost of produce and services previously, that is, we go here, that is down, and cost of produce of product and services now, and divide by previous. So you just collect the data of, maybe let's say I'm just going to be this one to see whether inflation has increased or not. So for example, let's say the brand was going at 50 bob, is going at 100 bob now, but previously the brand was at 50. Then you just multiply this times 100. So we multiply this by 100, we just get this is 2 times 100. You can see this is 200%, which means that the price has gone up by 100%. So it has actually doubled times 2. So actually you can see the inflation here has gone up. So the inflation has gone what? The inflation and it's gone up. Assume now the price of the bread now is going at 50, but previously the price of bread was going at 100. You multiply by this and you get the price is at 50%. So what has happened is that this inflation has actually reduced so much. And what can just cause this? There are differences that can just cause this. The reason we just see people maybe have this high inflation and all that is because maybe people are overspending, spending a lot and all that. Here people are saving so much, or maybe they don't have money, or maybe the price is high in the market and all that. So why are we interested in CPI in the USD? This is what happens when actually the data, when we expect maybe the CPI to increase, maybe let's say increase, when we expect the price to increase, what the government will just do is that, for example, assume in this case here we have very high this one, and we saying people are spending so much. What government will just do right over here actually to make sure that people don't spend a lot is that they are going to increase interest rate. Okay, so that is actually what happens when the government actually realizes that people are spending so much money, and what they actually do is just to increase the interest rate so that they can just encourage the people and the consumers to that is to save and all that. And let's see over here. So what will happen over here, people will now start saving money, that is ensures cool down spending. Okay, they just have to cool down the spending. Now what happened if the interest rate actually is very small, maybe they're very small? What government will just do over here is to reduce is to reduce interest rate, to reduce the interest rate so that it can encourage people to spend. Okay, they will just encourage people to spend money. Yeah, so that's what you have to know. Let me just brief this. CPI, increase in CPI will increase that is increase in CPI will just make the government increase the interest rate. At the moment actually the government increases the interest rate, will just make that the people or now have to save the money so that the economy can just be good. Let me just go over here so that we can just be checking something right over here, and I'm going to the calendar so that we can just be checking on this. And when we actually click the CPI over here, let me just click the one over here, the yearly one here, so that we can see what will happen right over here. And actually you can see the usual effect is that action greater than forecast is good for a currency. So when CPI actually increases, you expect that things are going to be good right over here, and that's why we expect things to be very nice. So for the currency, so we are going to assume something over here. I'm going for the monthly one, the first one here, to know what the money will just be doing. So maybe you can just take the action when you see the CPI, and maybe you can just wait maybe for the 1 week. You can enjoy a good profit out of that. I will see you in the next one. I hope this was simple. That is CPI, that is introduction to the fundamental analysis, how they affect the market to know the future. Subscribe to the channel if you just want. You can use if you you are searching for a gold broker that you can just use with the instant withdrawals and instant deposit. You can use the FXPesa. It's download over there free of charge, and when you just register using that link, you can just WhatsApp me so that I can just add you to my team. You start enjoying free classes. I will see you in the next one. Bye bye.